to lead up to a loan analysis because we want to look at purchasing the property. Why I do that, why I spend all that time, is because the most important thing is everything we just covered there. The loan analysis part is pretty easy as we start to look at that. So getting this right, selecting the right option, is often what puts people in the best possible position where they're happy with the policy and can use it to the fullest. Now, let's take a look at the loan analysis here. We're going to look at both option A and option B. What are the advantages here? Starting with option A, what do you have? Well, we saw it, $450,000 goes in, and you've got the ability to pay off that home immediately. No financing with a bank, institution. You financed it through your life insurance policy, and now you can pay the life insurance policy back at leisure or at your discretion. So that's an advantage. A lot of people like that because they don't have to deal with the bank, no closing costs, no fees, no mountains of paperwork, none of that stuff. Very, very easy. Option B, how exactly would you purchase that property? If you want to use the policy, that is. So if you don't want to use cash, if you want to float through the policy first, which some people like to do that after weighing their options, what you have to do here is make a partial payment in the first year. What I mean is you've got the approximately $200,000 in the life insurance policy. Perhaps we take a loan of $150,000 and then finance the remaining balance. You could do that. And then the second year, when you make the next payment into the policy, borrow out the rest, and then pay off that loan with the bank. So then I've got that loan outstanding for how long? 6 to 12 months. Not that long. Yes, I had to pay some fees, closing costs, everything extra that came with it. Some people might not want to do that. But some would look at it and say, okay, if I'm more comfortable with option B because I have more value, especially if I look at the guarantees, then yes, I'll do that because the additional value and performance I get here well exceed the additional fees and closing costs that I might have to deal with a bank here. I'll deal with that, no problem. It's just seeing those options up front. So partial payment in the first year and then paying the remaining loan balance in the second year. Here's what to measure though from a number standpoint. And this is what I like to do personally, and I found a lot of people like to go through this, is when looking to leverage a life insurance policy, the cash value to acquire real estate or anything that has a cost associated with it, cost of the loan interest for the life insurance product, or a bank if it's a collateral loan, is as follows. When I look at the cash value, what's the growth look like? Specifically, what's the dollar amount that you're seeing paid to you from the insurance company? What's the net growth on your cash value? And if you prefer to see that in a rate, what's the internal rate of return? They're both going to be the same here. One, we're just looking at dollar amounts. One, we're going to look at rate. And then do the exact same thing with the loan. What's the exact cost to borrow? The dollar amount that's going in interest to the lender. And then what's that rate? And then look at it year over year and see, am I paying more in loan interest than what the insurance company is giving me? Or is the insurance company giving me more in dividends and interest, total cash value growth, than what I'm paying in loan interest? Let's take a look. We'll look at both option A and B, and maybe we'll look at that 50K scenario as well. So, what we've got here, let's start with option A, because this does satisfy the client's objective of being able to pay off the property right away. We've got a lot of stuff here, so let's start off like this. What I want to begin with is as follows, just the policy values. Going back to the growth, here we go. $450 in the first year. Here we've got the cash value, here we've got the death benefit. This is option A. All the values are identical here. The only difference is now we're going to see the annual IRR, which isolates the annual growth rate every year based on the illustration and the present dividend rate. This does change over time. I would check out any of our videos that go through actual performance to see exactly what it looks like in terms of change as the years. We get a look at some historical performance there. But annual IRR, net growth rate year over year, CV growth, cash value growth. This is the net dollar amount that the policy is growing by each year. and then CV gain. This represents the total gain on cash value as the years pass. So look at this, between years 5 and 6, when I'm highlighted in yellow there, year 6, I've paid in $950. I've got $963, $661 in this example. So what's the difference there? Look at this, $13,661. That's my gain. All the years prior, I'm in the red because I've got less money in cash value than what I've paid into the policy. And the CV growth just isolates each year. So for example, year 3, sometimes we get this question. Year 3, I've paid in a total of $650. I've got $601. Yet here, the cash value growth is $91.82. Well, what's happened here is year 3, year 2, you're at $491. You paid in $100. If it earned 0, it would be worth $491. We're at $601. So we got our $100K back plus another $91.82, which comes out to 1.55%, the net internal rate of return, again, annualized for that year. So this is fantastic information when analyzing a policy loan because I can see, or I can compare this with exactly what I'm paying in loan interest each year. This is something I absolutely love to go through with people that we work with because we just get to see everything up front and we can make an informed decision. I'm also a nerd when it comes to whole life insurance products and this kind of stuff. So this workbook is meant to model how cash value collateral loans work. It does not model how direct policy loans work. It's very, very similar when you look at exactly how much you can borrow relative to what you've got in cash value. But in order to see what an actual life insurance policy loan looks like, that is something we would model in the software and show you that way. And then also take it a couple steps further. What's it look like if you borrow, repay it, don't repay it, pay interest only, see the different options up front. But here, this is just a quick workbook that we can use on the fly. And here's what we've got. So LTV stands for loan to value at 95%. So this is going to pull whatever we plug in here from the illustration, $400,000, that was from the detailed illustration. 95% of that is that dollar figure right there, 380. Available equity. This represents how much money we would be able to borrow. And again, this just provides a quick snapshot if someone's using it on the fly. We would get accurate numbers from the insurance company or from the bank if it's a third-party loan. This number, however, will change if I have a loan balance outstanding. If there's no loan balance, the available equity will always match the LTV. Now, what we want to look at here, interest rate, 5%. Before we even take out a loan, look at the annual IRR. Does that ever hit 5%? Gets pretty close, but the answer is no. So does that mean that the cost to borrow always exceeds the internal rate of return? Yes, if you could borrow 100% of the cash value, you would see the loan interest that you're paying, that would exceed the actual interest earned on the policy in this particular case. However, what we always want to remember is if we're not loaning 100%, because we can't loan 100%, what would happen here, let's say you loaned, I'm going to plug in the number in a second, $300,000. 5% would be due on $300,000, but you're still earning whatever that internal rate of return is on your full cash value. Remember the core benefits to a cash value life insurance policy? Safe, no risk, continues to appreciate. Liquid. Once a dollar passes through the cash value, continues to compound, regardless if I borrow against that policy or not. So there's no lost opportunity cost there. Keeps on moving forward. So I get that IRR on the entire cash value. So it is important to look at the rate. Here we've got 5%. We can actually adjust the rate on this workbook because it's meant to model the cash value collateral loans. So what does she want to do? $370,000 loan to purchase that home she's interested in. It's not quite an investment property, but a second home. Could use it as an investment property. And here we go. So we plug a $370,000 loan in the first year. And what do you notice here? So LTV was 380. Annual loan, took a draw there, it works like a line of credit, 370. Remaining equity, $10,000. Loan balance, 370. 5% of 370, $18,500. Interest payment. So this calculator here will always assume that you're paying the loan interest. 18,500 comes due, we pay it. Total interest payments will tally up all of the interest payments you've made over time. So if we just pay interest only, well, we're going to pay a lot of interest as the years pass. That rate will also fluctuate. However, 370, let's look at paying it back. So in light blue, on the far right, let's pay it back at, let's do 30 grand a year, 2,500 bucks a month. And this calculator does assume annual payments. So if I'm paying it monthly, I'd pay it down a bit faster. And what do I got left? 10 grand. There we go. So here's where it gets fun. I see it paid off here. Beautiful. But I don't really want to look at the payoff because the payoffs, or the amount I paid back, was $370,000 in principal payments. What I want to look at is as follows. Let's look at the rate. So let's start in year 2. 5%. Annual internal rate of return, negative 1.61%. If I look at the first year, yeah, that's worse, negative 11%. But first year, or second year here, it hurts me. When I look at the cash value growth, negative $8,000, and I've paid $17,000 in loan interest in this example. This example, how this calculator is built, assumes that we apply $30,000 toward the principal first. So if I didn't do that, then interest might be a little bit higher, unless I'm chipping away at it beginning the prior year. But it's, again, just gives you a quick example. Next year, I'm sorry, let me look over here. Total interest payments by the second year, $35,500. Gain on policy, negative $58,000. So I've got a hit. This is the drawback. Like why someone wouldn't do this strategy is based on the short-term results of the policy and still paying loan interest. However, where people are attracted to it, it's really as time passes. So let's look at year 3, still paying down the loan. Here's your interest. Here's the interest cost, $15,500. What was the annual growth? $9,100. So the difference there, you could argue would be, or I'm sorry, the cost there, you could argue would be the difference between the two. How about the next year? $14,000 in interest that you paid. Policy gain, $14,924. So I'm slightly positive here. Now how that works is because I've got the 5% cost to borrow on 280, while the 2.13 IRR is on 716. So yes, it's a lower growth rate, but on a larger bucket of money. Now, let's look at year 10, age 60, $100,000 remaining in a loan balance, $5,000 at 5%, $5,000 in interest I paid. Okay, the growth, $64,000. All right, so that's, yeah, makes sense, no problem there. But 10th year here, here's a good column to look at. You paid $117,500 in interest. What's your total gain on the policy? $216,000. Okay, so the gain is exceeding the total amount of interest I've paid. We can also look at here, it's actually 2 years prior, where it's almost, the gains almost equate to the total loan interest I have paid over time. I've got a total gain of 95, and the interest there is 106. But just measuring it year over year and then also looking at the total interest paid compared to the total gain on the policy, this is the kind of stuff that it has been extremely helpful to individuals in making a decision. Of course, anytime we're helping anyone with this, we want to look at the actual numbers with the insurance policy. If we're looking at a cash value collateral loan, we do want to work with the bank as well so we can see the exact numbers, as this schedule just gives us a quick 90% estimate of what things could look like, but it's all hypothetical, right? Just in the effort of full disclosure and such. Let's look at option B here real quick. This would be pretty cool. So how we do this is, one, we want to plug in the outlays. There we go. And then we want to plug in the cash value figures. And one thing we always want to do here is cross-reference everything with the illustrations to make sure it's accurate, or just run loan illustrations directly with the insurance carrier software. But this gives us a quick overview here. So here, we couldn't take out a $370,000 loan in the first year. We wouldn't be able to do it. So let's do this. Good. Let's assume that I don't do this, that I do this. That's much better. Good, good, good. And let me just correct this here. Okay, so this will get corrected on its own. So first year, 189. Let's assume you take a loan of 150 and pay interest only. The next year, let's assume you loan out the remaining amount needed. That would be 180. No, I'm sorry. 220. There we go, 370. So here we go. So I would do the exact same thing. Let's assume beginning year 3, we begin to repay the loan. Can do it the same dollar amount, $30K per year. And there I go. Well, there we go. Total interest paid, annual interest paid. And what we might look at as well, just to see a hypothetical scenario, is what if we went with that option B, but she said, you know what? If I'm going to repay the loan, I'm not going to be able to put $100,000 per year into my policy. I'm only going to be able to do the $50,000 per year. That's where it's good to see option B in advance. There we go. Early years, we've built up enough equity where we can take the loans needed, and then we begin to repay it. Maybe we pay it back more aggressively because we're paying less into the policy. So we pay it back more aggressively in order to save ourselves some loan interest. There we go. Which puts me in a good position. And then we measure the cash value growth compared to the annual interest and see, are we behind? Are we ahead? What is truly in my best interest as the policyholder, as the consumer? That's really what we like to look at. So I hope you enjoyed this deep dive video. If you did, please hit the like button, subscribe for more. And if you have any questions, feel free to send us an email or leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.